In your current module, so you got, this is week 14, here we are already. We're going to obviously wrap up chapter 9, but this account classification review is the document that I've been referring to when talking about the cumulative part to your final exam. So your final exam is going to be on chapters 8 and 9, and then you have this little cumulative piece that kind of goes with it. So as far, or not 8, 9, I'm sorry, 9 and 11, good grief. So chapters 9 and 11, and it's going to work just like all the other exams worked. The only thing that you'll find additional on the final is this little piece here. And so there are a bunch of sheets, tabs at the bottom there. I'll go through each of them for you. So this is exactly how the final exam cumulative part is going to be set up. I'm going to give you a paper that looks just like this. And there's going to be, and what you see up here is a list of accounts in order of the way they appear in financial statements. But I'm going to select 20 or 25, I think it's 20, random accounts from this list. And you're going to have to tell me if the account is obviously an asset, liability, equity, revenue, expense, if the normal balance is a debit and a credit, and on what financial statement the account belongs. And so, for example, cash is an asset, right? So you put a check mark in the asset column. The normal balance of an asset is a debit, and we'll find cash on the balance sheet. Got it? So this is kind of like, bringing together all of the accounts that we've at least been exposed to, we've used in journal entries, we've seen in different transactions, and making sure that you're kind of staying up to speed on those 3 criteria, which are critical. And this is not something that just ends in this class. You're going to take finance class, you're going to take accounting 102. This is going to be helpful review for those classes as well. If you're an accounting major, this is something that we just kind of keep going over and over because there's a lot to sort of remember. So what I did was I listed the accounts in the order in which they appear on the financial statements initially. So you'll see that we've got cash and then all the way down, and I don't really know why I didn't continue. I don't know what I was thinking at the time, but anyway, this ends with land, right, just on this page. So those are all assets, right? So I did this for a reason, so that you started to kind of see how when you have the same classification, the other 2 columns have to be the same. So my point is these are all assets, right? And so if I go down through here and I start doing that, right? Well, all assets have a normal balance of a what? A debit. Yeah, and so, you'll obviously, oops, I made a capital and then not a capital. And all assets go on the balance sheet, right? So it doesn't matter what the asset is. All assets have a normal balance of a debit. All assets belong on the balance sheet. See what I'm saying? So you kind of get into seeing that, and you're not, so when you get to my random list, if you've got cash and you have land, well, they're both assets. Your normal balance and your financial statement should be the same answer for all assets. You shouldn't be mixing them up, if you know what I'm saying, right? So that's the reason I initially present them to you in that order. So the first tab, sheet 1, these are all assets. If you go to sheet 2, you see I pick up here land improvements. These were all intangibles we talked about, all the way down to goodwill. Those are all also what? They're all assets, right? You get to, so this is how this will look here, right? These are all assets. Just bear with me for a second here so you can see what's happening. These are all assets. They all belong on the balance sheet. So you're like, well, this is simple for now, right? Well, it is. That's the idea. Then you get to accounts payable. And accounts payable is a what? Yeah, so then you're going to come over here and you're going to check mark liability. Well, interest payable, rent payable, salaries payable, sales tax payable, income taxes payable, common dividends payable, which I'll teach you about in chapter 11, and unearned fees and notes payable they're all liabilities, right? And liabilities all have normal balances of a what? Yeah, you see how this works? Okay, and then they all belong still on the, yeah. So the pattern, then you come to common stock, retained earnings, and dividends are all equity, right? So these are going to all be equity. Now, here's the thing though. You get to normal balances, common stock and retained earnings have normal balances of credits, but retained earnings has a normal balance of a debit. Common stock and retained earnings go on the balance sheet, right? Dividends go on statement of retained earnings. It's the only account. Actually, retained earnings can also be on retained earnings, but it's also on the balance sheet. So this makes you think about where the accounts belong on financial statements. So as you proceed down the list, you start with sales, and sales is a revenue, right? And revenues now go on the income statement. Sales and fees earned are credit balances. Sales discounts is a contra account. So it's got a debit balance. If you go on to sheet 3, you'll see the rest of them. Starting with cost of goods sold, those are expenses. So the rest of those will be expenses. There are 57 accounts that we've either talked about or will have used by the end of chapter 11. So they're all here. And again, I listed them intentionally: assets, liabilities, equity, revenue, expense, to make it easy for you to go through this and fill it out. Then when you kind of get to sheets 4, 5, and 6, I'm playing around a little bit with randomizing, and I use this tool in here, but you can kind of come in through here and then practice the randomized list, right? So you're preparing for the test. Utilities expense doesn't really make a lot of sense up here, but you've got all of these, right? So then you practice. You got sheet 5 where there's another randomized list. Sheet 5 is a really good example of what the final exam might look like, because there's a random list of 20 accounts that I pulled from the original list of 57. You guys get it? Okay. And then I have like 3 or 4 different versions that I give out during the final, so that the person sitting next to you on either side of you doesn't have the same list. So you need to know them all. Yes?
So you said this is the only cumulative part?
That's the only cumulative part. That's it. It's the only cumulative part. I'm not going to post the solution to all this. I just stood up here and did half of it for you anyway. The idea is that you work through this on your own. That's how you learn it. That's how you review it. That's how you practice it. If you want to know if yours is correct, you will come and see me and I will look it over and I will tell you if it's correct, but I'm not posting all the check marks in the right place for you. That's part of the review, right? If I do it for you, you're not going to review. But I at least am giving it to you in advance in this format for you to start working through it and to prepare in advance of that cumulative part. So sheet number 5 is a great example of what the actual sheet looks like that I will give you with the final. Okay? Make sense? Any questions? So that's yes. Monday, December 4th is the 4th of Monday so our block time is 8 to 10, but we won't start until 8:30. We won't start until 8:30. An hour and a half is plenty of time for the final. Nope, you don't have to be here till 8:30. Yeah, that's kind of the point, because 8 a.m. I know people are like, oh God, 8 a.m. So we'll make it 8:30 because you don't really need 2 hours. This is the only cumulative part of the final exam. The rest of the exam is going to be like normal. Chapters 9 and 11, nothing out of the ordinary, just like the other. And I'll obviously do more reviewing with you the last week of class. But I wanted you to have this in advance in case you wanted to start working on it, working through those. What I don't want is somebody emailing me at Sunday night at 9 o'clock asking me to check this. I won't do it. You've got 2 solid weeks to work through this, right? Do not email me the night before the final and want me to, go over this because you're last minute and that's when you're studying. Do this in advance. If you do it with a group of people, just have one of you just needs to come and check it with me, and then you can report back to your friends and you guys have the solution there. But I'm not going to be posting a solution. This is for you to work through so that you get the practice, and you, especially this first few pages where like you're developing these patterns, it makes a lot of sense to look at it that way first and then mix it up. And remember, if you label something number 1 as an asset, number 5 as an asset, number 13 on the list as an asset, then you should have the exact same normal balance selections and financial statement selections for all of your assets, right? For all of your liabilities, for all of your, well, not all of your equity, there's a little twist in there, but your revenues and expenses. If something is a contra account, right, it has a different normal balance than the asset that it goes with, but it still goes on the same financial statement as the asset that it goes with. So accounts receivable less allowance for doubtful accounts. Accounts receivable is an asset, has normal balance of a debit. Allowance for doubtful accounts is a contra asset, has normal balance of a credit, but it still goes on the balance sheet. It's still classified under the asset column. I don't give you a contra column, so classified as the account that it goes with. All right. Some students will do this. I've had students do this, and this makes them feel better. You guys see what I did there? For allowance for doubtful accounts, I put parentheses around it. Why? Subtracts, it gets subtracted, right? So if you think of it that way, you subtract the allowance from accounts receivable. That's fine too, but it's got a normal balance of a credit, not a debit. It still goes on the balance sheet. So you got to kind of pay attention to those little things that pop in there randomly because, you know, they're all through there. All right, so questions on that? Everybody good? Perfect. Okay. So we talked about liabilities extensively last week. I spent a good bit of time talking about reviewing some current liabilities like sales tax and accounts payable, and then we did unearned revenue. Those were all things you had examples of. We did a couple of quick exercises together, and then we took a look at payroll. And I spent the rest of Friday kind of talking about payroll. I'm not going to test you on payroll. You're not going to have to do any kind of problem solving with payroll, but it's definitely something that all of us should be aware of. Not if for any other reason, is because we all probably work and have jobs at some point, and you should understand where your money's going. That to me is very important. So the rest of the chapter, and I kind of hand selected certain things, obviously, that I want to go over. So we're going to talk about, to round this chapter out, contingent liabilities. So first, I always ask students, what does the word contingent mean? Because if you don't know what the word contingent means, then I'm going to start yapping about stuff, and you're going to be lost because you don't know what the word contingent means. So when I ask when I say what's contingent, what does that mean? If something is contingent, like you getting a degree is contingent upon you satisfying all of the requirements here at St. Francis for graduation. Can you find another word to substitute for contingent in that sentence? No? Come on. It's contingent upon. I'm thinking of a certain word. You getting a degree is contingent upon you satisfying the requirements.
Necessary.
That's not the word I was thinking of exactly. Not necessarily. Dependent, right? It's dependent on. You getting a degree is dependent on you satisfying certain requirements. So the word contingent really means dependent upon. It means something else has to happen before you actually have a liability. Okay? I will use one example that I think is perfect, and there's multiple examples, but I'll give you one and then I'll add to it. A potential lawsuit, right? Companies get sued all the time. It is actually a normal part of everyday business for companies getting sued. Now, if I were to pull up any financial statements and show you in the notes of the financial statements, the piece on, lawsuits, you'd probably, maybe you'd be surprised, maybe you wouldn't, but there's always somebody suing somebody. So most retailers, most companies, most manufacturing firms, anybody where there's, a potential risk, which is pretty much every business, there is some lawsuit involved, right? Or somebody trying to, and you guys have all heard the stories, McDonald's coffee getting spilled on somebody falling down a stair of escalators, tires blowing up on a car, airbags, malfunctioning. You hear the stories all the time, right? So it's normal because there's always some risk associated with it. Whether or not those companies are necessarily found guilty or have to pay out any money is contingent or dependent upon several things happening. So that's probably the most obvious example. Companies are going to be required, we're going to look at when they're required to actually let the person who's let the reader of the financial statement know, hey, I got this potential lawsuit that could really financially impact my business. And some of them, like you think about some of the tire ones, Firestone, even the airbag, we're talking millions and millions of dollars. Tobacco companies, paid out all kinds of huge amounts in settlements. That materially impacts a company's financial statements. Potential investors have a right to know about those things, right? Is this just like normal people suing me because they're trying to make a few bucks? Or is this something serious that I'm going to really have to pay out big bucks for. So when it's contingent, it hasn't happened yet. That's the whole thing. It hasn't happened yet, but it might. And so we have to kind of determine how likely it is going to be to happen, and then can we put a dollar amount on it? Those are not things that are easy to do, but companies are required to try at least. Other things that are a little bit more easy, things that might happen, are warranties. If you buy a new car, you get a warranty with your new car, right? Warranties are common, like 3 years or 36,000 miles, which means certain things are covered for 3 years or 36,000 miles, whichever milestone you reach first. And then after that, those certain types of repairs and things are going to come out of your pocket, right? Do automakers know when you drive off a lot if you're going to have warranty repair done? They don't know at the time, right? But it's possible, and that's something they owe you if you do have warranty, if something you need falls under that warranty. But they don't know at the time, so they're gonna have to try to estimate or figure out or guess how many people might come back with warranty repairs that they're gonna have to satisfy. So those things are difficult. We're gonna look at some guidelines, and that's really all we're gonna do. I'm not gonna really make you do journal entries or anything like that. But here are the guidelines. So contingent liabilities, generally speaking, are things that might happen. They are dependent upon other events happening, and you don't know that at the time, but you might be required to let your financial statement readers know. So there are, first of all, you've got to determine the likelihood that the event is gonna happen. And unfortunately, it's a really gray area with all of these. These are your choices. The future event is probable. What's probable mean? It's probably gonna happen. Yeah, I mean, are we 100% certain about anything that hasn't, that's in the future? No. I mean, but probable means, you're probably looking at some kind of a settlement, right, or payout. The second is possible. I kind of look at that as 50-50. It's possible, right? And remote means no chance. There's always going to be somebody that says there were, 17 ounces in this bottle and the manufacturer said there were 18. I mean, there's always going to be those people, right, that are looking for a reason. If you guys, I don't know if you pay attention to stuff like that, like you Google it, there are people out there who's made it their entire life mission, and they make a living off of suing companies. Like that's how they get their money, okay? Anyway, so once you decide what the likelihood is, then you got to say to yourself, okay, if it's probable, like it's going to happen, you got to think about this. The only way I can record a journal entry is if I actually know the amount. I mean, I got to debit and credit something, and I got to put a dollar amount in there. But if I don't know the amount, then I can't record a journal entry. So the only time we have to record a journal entry, so you'll notice here, record liability is way over here. So if the future event is probable, looking like we're guilty, right? And you can estimate the amount, estimable, that's a weird word. The amount is estimable. You can come up with an amount. We're getting sued for $7 million. Well, that's an amount, right? And it's likely I'm gonna lose, then I got an amount to put in a journal entry. And the journal entry is so pretty straightforward. Usually we debit some, this is just, that's not working. We debit, I did bring another marker though. Whenever we have these contingencies, and there's various journal entries, but for these contingencies, the general entry, and it looks like this, is a debit to some loss account. And a loss account is like an expense, okay? Loss on something. And we credit some liability account. I mean, this chapter, as I mentioned before, is all about liabilities, is it not? It's all about liabilities. And so every credit that we're pretty much dealing with is a credit to some liability account, right? So, I mean, that's if you're gonna, $7 million, that was my example. But you have to be able to estimate the amount. That's the only time you record a journal entry. And remember, it hasn't happened yet, okay? But this loss is like an expense, so it goes on the income statement. And this liability goes on the balance sheet. And the reason you're required to do that is because if you say, well, it's likely I'm gonna have this large payout, and if the amount's $7 million, that's a big number, right? And that's gonna materially impact obviously your financial statements. People have a right to know about that, because it might change their decision, okay? If you can't estimate the amount, like you know you're gonna lose, or you're gonna have to pay something out, but you're struggling, not sure about the amount. Well, you can't do a journal entry if you don't have a dollar amount. The next best thing that you can do is you can tell the reader of your financial statements in a note. So we've talked about the notes, how they accommodate the financial statements, and how we look at the notes for additional information. In the note, you could say, and every company is gonna have a note that says, hey, we have some lawsuits, right? Normal court, some of them are gonna say something about like being in the normal course of business, something like that. And some of them might, give a little bit more information, don't have an amount yet, something like that. Most of those should not be great cause for concern, because again, everybody gets sued. It's just what happens. Most companies just settle, they offer some kind of settlement, people go away, some money, and they're happy. All right, unless somebody, of course, died or was, injured to the, a lifelong injuries or something like that. Then you're talking something different there. But, and again, I use lawsuits because of the easiest thing, but there are other things, like I said, warranties. Those are examples of contingent liabilities. You may have to be paying out something to fix somebody's car. You don't really know that ahead of time, though. It's tough to figure that out. If you decide that your liability is possible, you got a 50-50 chance, you still got to talk about it in the notes of the financial statements. So the only circumstance where you record is if the likelihood is probable and you can estimate an amount. If it's probable and you can't estimate an amount, disclose in the notes. If it's possible, disclose in the notes. If it's remote, forget about it. You don't have to do anything, okay? Some crazy person's threatening to sue you. That happens all the time too, and nothing ever comes of it. Everybody's always, I'm gonna sue you. I mean, that's like, pretty common. Okay? Any questions? All right, so let's look at a couple of situations, I suppose. And then got a couple slides, we'll wrap that up. I'll give you guys back your exams then. So I'm actually, where am I here? I'm on page 359. And this is quick study 913. And again, this is pretty straightforward. I don't even know that there's anything for me to write on the board. So quick study 913, page 359, it says, Hupre, I don't know what I was gonna say there, is the defendant in the following legal claims. For each of the following separate claims, indicate whether they should A, record a liability, a journal entry, right? B, disclose it in the notes. Disclose means to tell about it, provide the details. Or C, no disclosure, do nothing basically, okay? Number one, Hupre can reasonably estimate that a pending lawsuit will result in damages of $1,250,000. It's probable they will lose the case. Record. See, I told you this would be easy. Record. Yeah, you got to record liability. In addition to recording the liability, you also got to disclose in the notes, though, too. You got to tell about it. You got to get the details. Okay. Number two, it is reasonably possible that Hupre will lose a pending lawsuit. The loss cannot be estimated. Disclose. Yeah, you can see this is going. You got an example of each of these, right? And then last, they're being sued for damages of $2 million. It's very unlikely or remote that they will lose the case. No disclosure. Even though there was an amount thrown around there, the chances that they're going to lose, right, are slim. Okay, that's all you have to know for that. That's pretty straightforward, right? Okay, just show you a couple other things here. Some of the other situations, in addition to the legal claims that I've already described a few times, right? A debt guarantee, and that is, like I mentioned earlier, a guarantee is like a warranty, okay? You get warranties with, new appliances, so those companies would have to try to estimate how much warranty repair work they'd have to do. It's not an easy thing to do, but there are mechanisms for doing that. Other contingencies like environmental damages, if you harm the environment, depending on what it is you're doing and where your business is, you've got potential issues there. Possible tax assessments, and again, these are things that you're not sure are going to happen. They all follow that checklist. Then what do you do with it, right? And then insurance losses, and government investigations. Insurance losses, like for example, take like a major national or natural disaster, like a hurricane or a flood. It takes months and months and months for insurance companies to figure out what the losses are gonna be, right? But if I'm a business and I just had, like my business was wiped out by a hurricane or something, I don't even have a building anymore, I got nothing left. Like, that's kind of, you know, that's gonna be a material impact my financial statements, because I'm gonna have to estimate that loss, right? So even though I won't know the exact amount for a while, and I really won't know how it plays out entirely, who's at fault, well, if it's a natural disaster, it's, I guess it's nature, right? I won't know entirely, you know, an actual number yet. I still gotta talk about it. I still gotta tell my readers of my financial statements about it. I probably have investors, they wanna know what's going on. And then government investigations, which, good Lord, they can take forever. Did you see the federal government can't account for $3 trillion of money? Did you guys see that? I can't remember what unit it was exactly. $3 trillion. They just don't know what happened to it. They don't know what happened to it. $3 trillion. I don't, it's really hard to wrap your head around $1 trillion if you really understand how many zeros that is and what that looks like. $1 trillion. $3 trillion they can't find. Now what do you think will happen to them? Exactly, nothing. All right. Other contingencies, oh, we kind of looked at that. And then uncertainties, future events that didn't necessarily arise from past transactions. Those are really tough. You don't disclose those. Life is an uncertainty, right? If you own a business, every time you open your front doors, you've got uncertainty. But companies do a number of things to mitigate the risk. So you got, and maybe you guys don't pay attention. I use grocery stores as an example for so many things. Does anyone know why the customer service area in a grocery store is in the front of the store and not in the back of the store? Okay, I'm thinking more in terms of, you're not wrong, but I'm thinking more in terms of risk. Well, so if the only reason I'm going to the store is to return something or to, you know, complain about something, or I don't know, I don't need to walk through all the aisles. You know, it's a risk every time additional person walks down an aisle. Insurance companies look at that, how your store is set up, and how many people actually walk up and down the aisles, because it's risky. If something could fall off the shelf and hit me, I could slip on something that somebody spilled and broke on the floor. So it's interesting if you understand risk insurance and looking at what's risk. Those recommendations are made to minimize risk. Fewer people walking up and down the aisle, which kind of is silly. You're like, well, it's a store, people have to walk up and down the aisle. Yeah, they do, but that's part of the strategy of risk. I mean, who's got a more, so you guys know, I think you know, my husband's a UPS driver. Whose job is more risky, his or mine? His, because he drives, he travels, he's in a truck all day, right? Getting in and out of a truck, delivering. So his, obviously, so the insurance that they pay for him to go to work every day, his employer, is gonna be higher than my insurance here, right? Because, you know, I mean, for the most part, low risk, right? For the most part. So there are things companies can do, obviously, to minimize risk, to eliminate it. You can never eliminate the potential problems, the potential liabilities that we've talked about. It's just impossible. If you're afraid of that, then you probably shouldn't own a business, because like I said, every business owner is going to experience something like that. Okay, so I told you guys I'll let you guys get out of here a little early. I'm gonna keep my promise here. But I'm gonna give you guys back chapters 4 and 6 first, all right? Because it's Thanksgiving, and I'm not always, you know, mean. I'm not mean. And then I'll give you guys 7 and 8. So you cannot keep them. I want you to take a look. Some of you, if you're borderline and you're concerned about your grade, 2 things I'll say. First of all, I did not put the extra credit in for mentorship day, and I have to obviously put homework in for the rest of the semester. I didn't do that either. But some of you who are struggling on exams might want to see me before the end of the semester. You might want to actually take time to really prepare for your exam, your final exam. I don't like to have people, sort of being pressured at this point in the semester, because it's not a great place to be, right? I prefer you to get to this point and be like, well, if I don't do so great on the final, my grade's still pretty solid. Some of you are not there. This stuff isn't easy. I'm not suggesting that at all. It's not easy. It's not. I say that starting day one. This class requires a lot of time and effort and attention, and if you're not willing to do it, then you're gonna obviously get the grade you get, but all right, so take a look. I know some of you are not, wait, who didn't get one? I was gonna say, since you're in here, I need to learn how long these people aren't here. Everybody, yeah, where's yours? I know you took it. Oh. I don't know why yours was sitting out. Okay. If you have questions and you're comfortable asking, ask. That's fine. If you're not comfortable asking, you can see me. I knew you were going to be mad at yourself. Grade these tests, and I think to myself, this person is not going to be happy.